Every war has a price. But if you think the bill goes to those who started it, you haven't been paying attention. I want to ask you this. Has your grocery bill gone up in the last few years? Have you wondered why rent has risen so much? Have you looked at energy prices and felt like something is going wrong? This is not a coincidence. This is a historical system crashing into you. And today, I'm going to tell you exactly how this system works. Welcome to Financial Historian Academy, to the intersection of money, power, and history. Here, nothing is as simple as it appears. In medieval Europe, the rule was clear. If you wanted to go to war, you had to get money from someone. When a king declared war, he had only a few options. He could raise taxes, he could seize lands, or he could debase the currency, mixing cheap metals into silver coins and presenting them as if they were the same denomination. Whatever he chose, the cost was both visible and brutal. Peasants were the first to feel it. Think of the 100 Years' War, which lasted from 1337 to 1453. England and France taxed an already crushed population again and again. Rulers squeezed merchants, clergy, landowners, anyone from whom something could be extracted. The result? Revolts, collapses, social turmoil. War was expensive. Everyone knew it. No one could deny it. In the 16th century, Spain learned this lesson in the most bitter way. Under Charles V and Philip II, endless campaigns began. Even the tons of silver pouring in from the Americas wasn't enough. Spain declared state bankruptcy 3 times in succession, in 1557, 1575, and 1596. Yes, you heard that right. 3 times. War spending exceeded revenues. The bill came quickly, and when it came, it brought catastrophe. The critical truth of this era: the cost was immediate, and immediate cost bred resistance. But in the late 17th century, the world changed. A fundamental, permanent, irreversible change. In 1694, the Bank of England was established. This was not merely a financial institution. This was a structural revolution. Now a government could borrow large sums from private lenders, using its taxing power as collateral. It paid interest, but not today. Tomorrow. For years, this was the birth of modern public debt. Instead of immediate seizure as Spain had done, England could now issue bonds and long-term notes, promises to repay with interest. Investors lined up. By the time the Napoleonic Wars ended in 1815, England's debt-to-GDP ratio had exceeded 200%. If you saw that figure in a news bulletin today, you would panic. But no one panicked then, because the burden was no longer immediate. It had been spread across years. War had been financialized, and from this point on, there was no going back. Consider the American Civil War. The Union government both issued bonds and printed paper money not backed by gold, the greenbacks. Inflation followed. Prices rose. The cost manifested not as taxation, but as an erosion of purchasing power. World War I scaled this model up. Governments across Europe rushed to issue massive bonds. Citizens were encouraged, even pressured, to buy bonds through patriotic posters. The money supply expanded. The gold standard was suspended. And in Germany, what was the result? Hyperinflation in 1923. A loaf of bread required a suitcase full of cash. The lifetime savings of the middle class evaporated within a few months. This was not an accident. This was a mechanism. Inflation is not an unfortunate side effect of war. It is one of the ways war gets paid for. When a government cannot collect enough taxes and cannot borrow cheaply enough, it expands the money supply. It prints money. This printing erodes the purchasing power of existing money. There is no invoice. It doesn't show up on your paycheck. But the subtraction is real. From 1941 to 1946, America's federal debt shot up from 40% of GDP to over 120%. The war ended. So how was this debt repaid? By raising extra taxes on the wealthy? No. Through a quiet strategy called financial repression. The method was this: keep interest rates artificially low, allow inflation to run a little higher, And wait, if a government bond yields 2%, but inflation is running at 4%, you are losing purchasing power every year. The government repays its debt in cheaper dollars. Savers lose. Borrowers win. And who is the biggest borrower? The government itself. This is not a conspiracy theory. This is arithmetic. Come to the post-2001 wars in Afghanistan and Iraq. America entered these wars without a broad-based tax increase. Instead, federal debt doubled between 2001 and 2008. The bill was deferred. The credit card was swiped. And a credit card still has a statement date. This debt accumulation is not neutral. It must eventually be financed. It puts pressure on central banks. It narrows fiscal flexibility. It increases dependence on low interest rates. When it grows large enough, inflation stops being merely a side effect. It becomes a relief valve. In the early 2020s, you saw it all. But did you connect the dots? Massive fiscal stimulus, emergency spending, supply disruptions, geopolitical tensions. The money supply expanded dramatically. From 2021 to 2023, inflation climbed across much of the Western world. Official explanations focused on supply chains and pandemic disruptions. Those factors were real, but beneath them lay a deeper truth. When governments spend aggressively and finance it with debt monetized by central banks, purchasing power slips. And that slippage always moves in the same direction, away from those holding the currency. Let us pause here and ask an uncomfortable question directly. Who pays the real bill of wars? Those who go to the front pay with their lives. That is beyond debate. But the financial bill? During World War II, giants like General Motors, Boeing, and Lockheed filled government contracts and multiplied their capacity. Corporate profits grew. War mobilization cemented industrial dominance. In the post-2001 wars, Halliburton, Lockheed Martin, and Raytheon received billions in contracts. Investors holding those stocks experienced war not as a loss, but as revenue. On the other side, who was there? Ordinary workers on fixed salaries whose wages rose 2 to 3% while their expenses inflated at 6 to 8%. People with cash savings earning near zero interest while inflation ran above them. Inflation is a tax levied without legislation, and like most taxes, when measured against financial sophistication, it is regressive. If you own real assets, you are protected. If you depend on wages, you absorb the difference. In World War I, European aristocracy was shattered, but industrial capitalists tied to war production expanded their influence. In World War II, while Europe was reduced to rubble, the American industrial base emerged intact. American companies gained global reach and scale. In recent decades, when prolonged military interventions met accommodative monetary policy, asset prices rose. When central banks held rates low, cheap money flowed into stocks, real estate, and financial markets. Asset owners saw gains. Those dependent solely on wages were left face-to-face with rising living costs. The mechanism is not built on morality. It is built on assets and liabilities. Those with diversified portfolios are protected from the worst of monetary erosion. Those living paycheck to paycheck are not. Look at America today. Federal debt now exceeds 120% of GDP. Annual interest payments have become one of the largest items in the federal budget. This interest must be paid before any new projects are launched. It constrains options. It corners policymakers. When rates were raised sharply in 2022 to 2023 to fight inflation, the financing cost of this accumulated debt rose dramatically. Governments are trapped in a dilemma. Either allow inflation to continue and erode purchasing power, or raise rates and impose stress on the financial system. You cannot imagine a more fragile system than one dependent on a central bank to rescue the entire economy. You did not see a war tax on your payroll, but you probably saw higher grocery bills in recent years, higher rent, higher energy prices, government deficits swelling into the trillions, central bank balance sheets reaching unprecedented levels. These are not abstract figures. These are the accounting records of geopolitical ambition. Borrowing costs are spread forward through time. Inflation costs are spread downward through society. Financial repression quietly distributes both across decades. Meanwhile, hard asset owners, companies benefiting from war production, and capital holders live a different reality. The sacrifice is invisible because it is gradual, but being invisible does not mean it does not exist. When you grasp how wars are financed, everything changes. You understand why asset ownership matters so much. You understand why holding only cash in an inflationary environment is risky. You understand how large-scale debt creates structural incentives for policymakers. War is not only tanks and treaties. It is bond issuance. It is monetary expansion. It is long-term interest obligations. And once you see this, you notice something sharper. Those who design the financial system rarely design it to punish themselves. History does not repeat in the same form, but the arithmetic does not change. Governments borrow. Central banks monetize the debt. Currency loses value. Assets adjust. Wages fall behind. Wealth concentrates. The bill comes silently. It is paid by those holding the currency, by those with savings, by those without asset protection. It is absorbed by generations who had no say in the original decision. Soldiers go to the front. The bill goes to the future. Wars are loud. The financing behind them is silent, and it is in that silence that the real transfer takes place. If this perspective gave you something new, subscribe now. History conceals the answers. I show you where to look.